It's March 2026, and the federal tax code has undergone a broad replacement of existing rules. Congress has officially activated the OBBBA, overriding the regulations that governed the previous decade. But if you live or do business in California, the state government is legally ignoring that new federal law. California recently updated its tax conformity date to January 1, 2025, meaning any federal changes passed after that date, like the OBBBA in July, are not recognized by the state. This creates a structural discrepancy for taxpayers. Those tied to California must now calculate and file their returns under two different sets of financial rules at the same time. This legislative split restructures the math for three specific groups: families managing credits, tech startups handling research costs, and independent gig workers balancing 1099s. Navigating these two conflicting codes is necessary this tax season to avoid compliance penalties on one side or missed wealth-building opportunities on the other. The federal strategy for families begins by locking in the lower individual tax rates originally introduced by the Tax Cuts and Jobs Act. Instead of reverting to higher rates, those lower brackets are now permanent. Congress also permanently increased the child tax credit to $2,200 per child, complete with automatic inflation adjustments, though they added stricter Social Security number requirements to claim it. The code also introduces Trump accounts. These are new individual retirement accounts specifically for children under 18, allowing up to $5,000 in annual contributions. To encourage participation, a government-funded pilot program will automatically inject $1,000 into the Trump accounts of newborns between 2025 and 2028. However, California is largely decoupled from these specific individual federal changes. This means these federal tax breaks will not reduce a family's state income tax burden. Instead, California is focusing its family relief on pending reforms to the state's renter's tax credit, specifically aimed at lowering costs for taxpayers with dependents. Families must track these federal credits to build long-term savings, while recognizing that they will require an entirely different calculation to manage their California tax liability. For businesses, the federal code offers a path for physical expansion. 100% bonus depreciation is now permanent, allowing companies to write off the entire cost of qualified property acquired after January 2025 in a single year. Under Federal Section 174 rules, instead of deducting research and development costs immediately, companies must now divide and amortize those expenses over a 5 to 15-year period. California rejects this rule, decoupling from Section 174 to allow startups to deduct R&D costs immediately. Beyond immediate expensing, California has overhauled its R&D credit system for 2025 and beyond. They repealed the old Alternative Incremental Credit and replaced it with a federal-style Alternative Simplified Credit, or ASC. Under the new state ASC, startups can claim a 3% credit on current year qualified research expenses, specifically on the portion that exceeds 50% of their average expenses over the prior 3 years. Additionally, California now allows any unused R&D credits to be carried forward indefinitely, removing the previous 15-year expiration date. Because the state and federal government treat these costs so differently, tech startups must maintain two entirely separate sets of accounting books for their research and development to maximize their runway. Independent contractors are navigating their own set of shifting rules. At the federal level, the IRS has restored the Form 1099-K reporting threshold for third-party networks to $20,000 and 200 transactions. At the same time, the federal reporting threshold for standard freelance work on Form 1099-NEC has increased to $2,000, which adjusts the paperwork requirements for smaller projects. The IRS is tightening its grip on digital assets. Income from cryptocurrency and NFTs must now be explicitly reported using the newly deployed Form 1099-DA. This shift toward digital tracking extends to payments. Both federal and state tax agencies are phasing out paper refund checks in favor of digital direct deposits. California is also expanding its state-level e-filing mandates. Now, any partnership or corporation that meets federal electronic filing thresholds is required to file their California returns electronically as well. For independent workers, these updates mean a larger portion of their digital transactions and non-traditional assets are now visible to tax authorities through automated reporting. In the area of long-term planning, the federal government has increased the estate and gift tax exemption to $15 million, a figure that is now permanently indexed for inflation. However, high net worth business owners in California face different constraints. The state refuses to conform to the federal business interest limitation, which is now based on EBITDA. California also decouples from the federal 100% exclusion for qualified small business stock under Section 1202, a provision many federal investors use to protect their gains. This illustrates the central conflict of 2026. While federal law expands incentives for building and passing down wealth, California's nonconformity restricts those same benefits at the state level. Because the state and federal codes now diverge on everything from child credits to R&D amortization, taxpayers must verify which specific rules apply to each individual asset to ensure they are accurately capturing every available credit.